Thank you everyone for joining us today. Can you all see the presentation? Can you just put your comments in the chat box so we know that you can hear us and you can see the presentation? Okay, so let's go to the next slide. So we'll start with the general and financial disclaimers. So this is a 506B offering, which means that this information is only for a set of people that have a pre-existing relationship with one of the sponsors. This business plan contains privileged and confidential information, and we cannot generally solicit the investors. In terms of financial disclaimers, there are several future financial projections and forecasts, and these are the estimates which are based on a lot of assumptions which may or may not hold true. Next slide, please.
Surbi?
Yes.
Just a check, are we recording?
Yes.
Okay. Hello everyone, this is Jacinto speaking to you. Let me turn my camera on for just this session. I hope you can see me. It's a pleasure team. Let's just start with their track record and then we'll talk a little bit about each of them. Together, we have about $250 million in assets invested, as well as way over 3,000 plus units on doors, as well as an accomplishment of $50+ million in capital raised in previous deals. This is a very diverse group of people with very extensive real estate experience. In addition to multifamily, as you will see, they have experience with single family, commercial real estate, construction, and project management, as well as mortgage brokerage experience. So let's meet them. To avoid repetition, I'm going to highlight their experience beyond multifamily. As you know, everyone here has multifamily experience. The first ones that I want to talk about is Surbi and Achilles. They are general partners and passive multifamily investors with full cycle experience. Surbi has deep experience with distressed assets, foreclosures, and rehab projects. They both hold engineers and MBA degrees, and they brought this project together. Hanumesh is also an engineer, and you will see we have many of them. And besides his experience in multifamily acquisitions, he has also done some single-family home flip. Steve added the construction and project management experience to the table, and he holds a degree in business management. Steve's superpower is underwriting and business planning. Jai, on the other hand, has a single-family portfolio and is rapidly growing his multifamily portfolio. He is also an engineer and oil technologist with a success history in driving technology innovation. Last but not least, we have Mo Paknia. Mo is a real estate broker, a certified REO specialist, and a previous mortgage broker. He has been helping investors build their real estate portfolio, be it on the single family or multifamily space. On my end, I'm working on building my real estate portfolio so I eventually can leave my corporate job as a director of finance for a multinational in the consumer packaged goods. I also have an MBA and an accounting degree. One second here. Okay. This slide highlights our partners. We talked about the GP team on the left, and on the right, you will see some of our suppliers. We have the Patella Group helping us with the securities side of the deal and the contracts. Mayan Management will be our property management group. BMC Capital helped us with financing, and Raimi King will be our insurance provider. With that, I will transition the presentation to Hanumesh, who will talk about our property details.
Thank you, Taisha. I'll take it from here. Thank you, everyone, for joining. Taisha, let's go to the next slide, and we'll talk about our property details in a little bit. As you can see on our screen, it's a 95 unit with 4 buildings in the same complex. Each of those 4 buildings comes with a different theme, and it's built with a taste by the builder. And we are in a happening place in Dallas. As you can see, we are less than 2 miles from downtown, uptown, Deep Ellum, etc. I think this is an area which is undergoing transformation. People who are in Dallas would know this. You know, a lot of shopping complexes, offices coming around, a lot of new construction happening. And hopefully, you know, as this area gets more and more transformed, we'll adjust in the pricing in the next few years upwards from what you have seen in the past, from what you are seeing today. Hopefully the prices per square feet will move upwards in the next few years. Again, going back to the property, as you can see here, it's fully renovated. It was built studs up in 2018 with all new foundation, plumbing, everything interiors as well. Next slide, please, Nisha. Again, 95 units with almost 47,000 square feet of rentable space, and with different amenities, as you can see, spread across all the 4 buildings. We have courtyard pools in 2 of those buildings. We have pitched rooftops. We have a rooftop patio in one of the buildings, and we'll go as we go along for each of those properties. Taisha, next slide, please. Now, this is San Jacinto Koa property, which is built on Hawaiian Koa theme. As you can see here, you know, the backsplashes in the kitchen, you see the backsplash in the bathroom. As I was saying, each of those 4 buildings have been built with taste, with a unique feature which is unique to a different building. Now, here you see a beautiful courtyard. Next slide, please. This is our French Quarter building. So it's built on New Orleans French Quarter theme. It has, as you can see, the light fixtures in the living room. It has chandeliers in the hallways. You know, you'll see a different front doors. It actually has balconies in the first floor units. Next slide, please. This one is our San Jose theme. Again, a little bit Spanish theme. You'll see the front doors highlighting those Spanish theme here. Again, this one has a fitness facility. It has an on-site leasing office. And we intend to leverage this leasing office for all the 4 buildings. And in future, when we add more and more units to our portfolio, we'll probably use the same leasing office. Next slide, please. And again, this is our vintage one. And as you see here, it has, most important, it is a rooftop lounge that our residents can use. It has a cardio fitness facility. And this was fully renovated in 2018 as the other buildings. Each of those 4 buildings comes with washer dryer connection. So there is a possibility option of adding washer dryers in the future. Next slide, please. Yeah, Steve, you want to talk a little bit of Dallas market?
Yeah, thank you, Akalash, and good evening, everybody. Next slide, please. We've been extremely impressed with the growth of the Dallas-Fort Worth metro area, which has us confidently investing our own money in this market. The 2 most important market data points we look at are population and job growth. Texas was the fastest growing state in the country in 2020. Dallas was the fastest growing metro area in 2020 and 2021, according to the US Census Bureau, adding over 97,000 residents over the past year. This is in part due to Texas's booming economy, coming in second only to California at $2 trillion. Texas offers a business-friendly climate with no corporate or personal income tax, easy access to global markets, and a highly skilled and diverse workforce. Next slide, please. Dallas is home to 24 of the Fortune 500 companies, including AT&T, Southwest Airlines, and Charles Schwab. The continued influx of large private and public companies relocating to Dallas has helped push job growth to over 248,000 new jobs year over year. Relocation reports over the past few years have shown staggering numbers of both domestic and international migration to the great state. Next slide, please. To summarize the past few slides, here's a roll-up of the top 4 reasons Texas is seeing such high demand and growth and will continue to trend in this direction. The strong job market and wages, booming job growth has turned Texas into an economic powerhouse. On the world stage, Texas would be the 10th largest economy among nations. Lower cost of living, Texas residents enjoy some of the best living conditions in the country. Energy costs are among the lowest in the country due to deregulation. As stated previously, Texas is one of the 7 states in the country that don't collect personal income tax. It's a family-friendly and diverse area. Dallas is known for its art district, sprawling parks and outdoor activities, professional sports amusement parks, nightlife, as well as shopping districts and boutique restaurants. Dallas is home to some of the best school districts in the country and ranks second in diversity. Next slide, please. On this slide, we're going to talk about sales and cap rates. One of the many reasons we're extremely excited about this property is the purchase price. We purchased SanJacinto at $137,000 per door. In relation to recent sales over the past year, East Dallas submarket has an average price per door of nearly $200,000 this year and forecasted to increase another 15% to $225,000 over the next 4 years per CoStar. The graph to the right shows us cap rates. Cap rates, for those that may be unfamiliar, the cap rate or capitalization rate is the ratio between the annual net operating income produced by the asset to its current market value. Property values increase when income increases, expenses are reduced, and/or the market cap rate compresses. As operators, we focus on the controllables and expect a higher cap rate at the time of sale. As you'll see in the chart, cap rates have been falling the past 5 years from 5.4% to about 4.5% today in the East Dallas submarket. CoStar forecasts cap rates in 5 years to be at 4.6 to 4.7 range in this submarket, which would yield even greater returns for investors. Survey will talk more about this in the financial section when we talk cap rate sensitivity. Next slide, please. Often accompanied by great location is a strong median household income. We're excited that $65,000 is what the 1 mile radius is showing us here. It also supports that the market is able to absorb future rents and be well within the 3 times qualifications that we have for tenants. Household growth in a 1 mile radius has impressive growth as well at 4.3% year over year and is expected to keep this trend for the next 3 to 5 years. Next slide, please. With Dallas's great economic drivers comes strong demand in rentals. East Dallas submarket effective rent is up 15.8% year to date, and occupancy is consistently hovering at the 93 to 96% mark. Rent growth is expected to slow down, however, still net nearly 5% rent growth on average over the next 5 years. Next slide. East Dallas provides an extremely attractive up-and-coming alternative for renters priced out of the uptown and downtown submarkets that are our neighbors, yet still in close proximity to vast cultural attractions and major employment centers. We are in the path of development and regentrification as developers have honed in on the vibrant East Dallas submarket, focused on attracting young renters to all the area has to offer. Next slide. As we can see on the map, renters enjoy close proximity to downtown Dallas, just 2 miles away. Deep Ellum, just southwest. Deep Ellum is the live music capital of North Texas, as well as a hub for the performing arts. Lower Greenville, just steps north. A quaint neighborhood, just a few steps north of San Jacinto, offering a robust scene of bars and ever-increasing number of noteworthy restaurants. Next slide. Here I'll pass it over to Jai, who will walk us through our business plan.
Thank you, Steve. So as mentioned earlier, that this is a Class A portfolio, which was fully renovated in 2018. So good news is that there is not much to do to bring this asset to a high level. In our business plan, we have considered some value-add projects to drive our growth in rental income and have new streams of other income revenue. We would do a few interior upgrades, such as changing the cabinet handles to brushed nickel, change light fixtures and faucets in some select units, install backsplash in the kitchen. And one of the asset here in this portfolio has a townhouse, about 1,200 square foot area, which is 1 bedroom and 1 bath at the moment. We would add a second bedroom to that townhouse and increase the rent. To add to the new stream of other incomes revenue, we would install washer dryers in those units that already have washer dryer connections, as mentioned by Akhilesh previously. We would build a few covered parking slots, install smart tech packages such as Ring doorbells and smart thermostats such as Nest. Valet trash is in high demand in Dallas by the tenants and will be implemented. We would be able to charge monthly rent for most of these value adds as a other income revenue stream. We would also do some exterior work such as improving the pool furniture and landscaping for tenant retention. And also, finally, we are working with our property management company called Mayan, where we are reviewing all the vendor contracts, looking for the opportunities to optimize expenses and reduce overall cost. Next slide, please. This slide here shows the impact of the new stream of other income revenue on the value of the property. As Steve mentioned, and most of you already may know, value of the property is calculated as annual net operating income divided by the capitalization rate. So let's look at one of the revenue stream here, say row 3, washer dryers. So we plan to add washer dryers in 40 units and charge $50 for each of these washer dryers. This would increase our net operating income per year by $24,000. Now, at 5.25% cap rate, which we have considered in our underwriting, washer dryer income would increase our value of the property by $457,000, which is $24,000 divided by 5.25%. So by doing these value adds, the additional income stream, our property value would increase by $1.12 million. Next slide, please. This slide here shows the CAPEX budget allocation. So as mentioned here, we don't have a big CAPEX budget. However, we have allocated a few numbers here for covered parking, some minor repair work to be done on the roof, doing some drainage improvement for the rainwater drainage, and we will keep $100,000 for the deferred maintenance as and when it's needed. On the interior side, we have allocated some budgets, as you see on the table in the right side, for the upgrades we talked earlier in the previous slide. Now, one thing I would like to highlight here is that we have $100,000 of working capital and $400,000 of total CAPEX budget. And all of this CAPEX budget is unfinanced. Now, if we have finance this CAPEX budget and ask lender to pay some of it, they have the full control and they will tell us where to use it and when to use it. Because we have an unfinanced budget, which means we are raising this $400,000. This gives us a flexibility to use it as and when needed. Next slide, please. I'll then pass it over to Surbi for financial highlights.
Hi, everyone. So let's go through some numbers. We are looking at a total return of 90 to 100% and an annual return of 18 to 20%. Year-over-year cash return, we are looking at about 5 to 6% and a holding period of 5 years. A good thing about this property is that we already secured a fixed rate interest loan at 5.13% from Freddie Mac. Our loan amount is approximately 8.2 million at 63% loan to value. So some of the things which other speakers have already talked about is that this is one of the best rental submarkets in the Dallas-Fort Worth Metroplex with a rent growth of about 15.4%. We got it at a very good price of $137 per door, whereas in the neighborhood, the properties are selling at $160 to $200K per door. We have multiple major employers within a few miles of this property. And also we have multiple opportunities to increase other income and add value to the property. Next slide, please. So these are some of the recent sales comps, and you can see between February to May or June, these are the properties which actually sold in this neighborhood. And the lowest comp is at 158K per door, and the highest comp is about 190K per door. And we are under contract at under 137K per door on this property. Next slide, please. This is a disclosure on the fees. We are looking for a minimum investment of $50,000. Acquisition fee and asset management fee is 2%. We are not charging any refinance or disposition fee. The sponsor split will be 80-20 till the time we double the investor's money. And once we provide a 2x multiple, the sponsor split will be 70-30. Next slide, please. These are some of the highlights from our underwriting. So if you see, we have a total 5-year return of 97% and an average cash flow of over 5%. We are projecting a below average market rent growth of 10% in our pro forma. And most of the leases we are looking to renew are from last year, 2021. And in last 1 year, the market has grown by over 15%. And these are some of the rents we are already achieving on our new leases. So we are being a little conservative on our rent growth. In terms of loan, we already have a 5-year fixed agency loan. And we have about 500K, which we are already raising as a capex budget upfront. So we don't have to go back to investors for more funds at a later point of time. Next slide, please. This is our 5-year cash flow. And if you look at this green bar in the top, it shows the economic vacancy that we are projecting. And as Steve was talking earlier, in East Dallas submarket, the physical vacancy is about 6-7%. But we have taken pretty high economic vacancy of 15% and 11% in the initial years, which is very conservative, and it will help us. Most of this vacancy is because of the loss to lease, which means that our leases are not up to market rents yet, and we have a opportunity to grow rents and bring them up to market. So as our leases come up to market, all this economic vacancy will go down significantly. But we're still keeping 9% stabilized vacancy just to be conservative. Even with this high economic vacancy, we still have a very healthy cash flow between 5.8% in year 1 to about 8% in year 5. Also, if you look at the reversion cap, we have taken 5.2% reversion cap, which is 50 basis points higher than what CoStar is predicting for 2026. I think it was about 4.7%. So again, we have taken a conservative reversion cap. It gives us a lot of cushion and gives us confidence in these numbers. Next slide, please. So in addition to our underwriting, we did some stress testing scenarios, like things don't go our way, then what happens? Next slide, please. So first scenario is at what point does our cash flow become break even, which is that at what economic vacancy do we generate zero cash return? And based on our analysis, even if our economic vacancy goes up to 32%, which means that the property is only 68% occupied, we still break even, which means that we are able to service our debt, we are able to meet all our obligations, and the cash flow to the investors becomes zero at this point of time. So just to stress, even during COVID, I don't think many properties went to this level of economic vacancy. So this is a very big number, high cushion for us. Next slide, please. The next scenario is, let's say there is no rent growth and there is no other income growth, but our expenses still continue to grow. So even without any rental growth and other income growth, we are still generating a healthy cash flow, as we can see this yellow highlighted row below. So this again gives us a lot of cushion in our underwriting. Next slide, please. So third scenario is, I think this is on top of mind of everyone right now, the way aggressively the Fed is increasing the interest rates. But in our case, even if the interest rates keep going up, there is no impact to us because we have a 5-year fixed rate loan. So for next 5 years, our debt service is fixed. It does not impact us. We are pretty stable. We don't have any interest rate risk. Next slide, please. So here is a reversion cap analysis. As Steve mentioned earlier, in our underwriting, we have taken a 5.2% cap rate, which gives us a return of 97.4%. Now, let's say the cap rate is much higher, which is 5.6%. Even then, we generate 82.3% return for our investors. On the other hand, if the cap rate is 4.7%, the way CoStar is projecting, our return is about 129%. So even though the cushion, like 4.7% to 5.6% is a pretty wide range, the property still generates a healthy total return of 80% to 130%. Next slide, please. So this is one of the scenarios, I think, which is a very likely scenario. So what happens if the interest rates go down? So initially I talked about our interest rate being fixed and our debt service cost fixed. But the way we have structured our loan, we have only 1% prepayment penalty in year 3, which gives us the flexibility to refinance after 3 years. So, and this is a very likely scenario that the interest rates will go down in a couple of years. So let's say we refinance in year 3 and our interest rate just goes down from 5% to 4%. And we refinance this property with an LTV of 65%, where we are currently. So with this refinance, we are able to return 3.8 million to the investors in year 3, which bumps us our cash on cash return to 8.3% from currently what we're projecting at 5%. So a lot of times when you see promoters coming to with high cash flow numbers, that's what they're building in their scenario underwriting. But we have not included this upside in our underwriting. We just wanted to be conservative, give a number which is achievable. This is a very likely scenario, but we don't know if it will happen or not. The next scenario is, let's say we refinance in year 3 with 4% return, with 4% interest rate and an LTV of 80%. So this will allow us to return 5.8 million to the investors. And our initial investment is also close to 5.8 million. What this means is that for first 3 years, our return is 4.6%, but then we have infinite return thereafter because our investment becomes zero at this point. So this is something which all investors live for, to achieve infinite return, because then at this point of time, there is no risk in the investment and it can generate cash flow and returns for the rest of the life of this property. Next slide, please. So Taisa, you will talk about the next 2 slides.
Thank you, Surbi. So what are the next steps? We hope you are interested in investing with us, and we are about in the middle of our timeline with the webinar happening today. You can expect that the subscription will open tomorrow, so please reach out to your GP so you can get access to our investor portal. And our intention is that the closing date is scheduled for November 10. This being a Class A property, the fundraising not being a large fundraising, we expect this to fill out soon. So we ask you that you be, if you're interested in investing with us, you invest quickly, because this subscription will hopefully end soon. So how to invest? There will be a portal where you can get access with your sponsor, and you will, in the portal, you will find our contracts, and you will be able to review the documents, sign the documents. We will review and accept your investment, and then once you receive an okay back from your sponsor, you receive the wire instructions to send us the money, which we expect you to send you. If all of that will be about 2 days after you sign, we should be able to turn it around and receive your funds, so we are ready to go into closing. Team, did I forget any important piece here?
No, I think you're good, Taisa. I think most of the investors are repeat investors, so they know the process.
Okay, thank you, Surbi. With that, I just want to close what we presented here today and what we need to invest right now, right? You saw the returns. This is a Class A asset with solid returns, with a fixed rate loan, which interest we have already locked. It's for a 5-year period with a strong and experienced sponsorship team. On top of that, we are coming to close to the end of the year. And for you guys that are investors already, you know the tax benefits that you can get from investing in real estate, but I will briefly outline them for the new investor. When we invest in real estate, because of tax regulations, we can do a cost segregation and identify the life of all of the assets within the property, and they are depreciated at different rates according to this legislation, which will allow us to generate paper losses. So even your year-over-year cash return of 5%, you will be offset by the paper losses created by the tax regulation, which is really the government incenting us business people to work on housing, which is something that they don't want to work on. In addition to that, we know that multifamily assets have performed exceptionally well during economic downturns, which is we are on the verge of. So therefore, it is going to be a good hedge against that and the inflation that you have already experienced. So we believe the time is now. This is the last year that we can get the most benefit from the cost segregation, and we are coming close to the year end. So if you haven't deployed your cash yet, you're expecting either to GP, you might want to consider lower risk investment in a Class A, which by the way is an attractive investment for buyers as well, which hopefully will also benefit us on the end of the deal when we are trying to exit with multiple offers. So I think this is a win-win, and we invite you to join us, and we invite you to have a conversation. If you're not, when we went fast through all of this, but if you have questions, please talk to your lead GP and ask, because I think they will be able to answer all of your questions. With that, we are going to move into a Q&A, and please add your questions to the chat, and I'll read them so our sponsorship team can try to address any questions you might have.
So Taisha, I'm already seeing some questions in the question panel. So first question, why is this property selling below market price? So I can answer that.
Can you repeat, Serbi? Your voice faded a little bit. Want to make sure everyone understands it.
Why is this property selling below market price? So I think the owner of this property, this portfolio, is a builder who bought these lots in 2017 and then did all this grounds up development and reconstruction. They have a 5-year loan which is maturing now, and this property was listed for 14.5 million in April, and we were able to negotiate it down to 13 million. That's one reason. Second reason is the builder is not in the business of managing the property. They're self-managing it and not doing a very good job. So they want to focus on, they are building some new construction properties in Denton. So they want to focus on their own business and move out. So that's how they make money. They've made probably 2 to 3 times return on their investment already. So they were a pretty motivated builder. They wanted to get out of this. So
I'm going to ask you to continue reading the questions because I cannot see them.
Okay. So the next question is, what percentage of total property is rented, and what is average length of stay? So I think our current occupancy is about 94%. And typically we sign the leases, we stagger the leases 6 months, 9 months, 12 months. the management company has some formula. They don't want all the leases to expire at the same time. So based on the analysis, they want to make sure that we have a stable turnover of property every month. So they do this analysis and then sign the leases accordingly. But ideally, again, there is an upside and downside of renewing the leases with the same tenant. Because on new leases, you can get higher market rents. On renewals, you may have to split that difference, but then it increases your physical vacancy. So that all analysis property management company does, and then based on the occupancy and the number of renewals and all, they decide how many to renew and how many to turn over. So the next question is, with all this extra stuff added, I mean, for the other income, it will increase the rent as it won't be optional. Will it put these rents beyond market range? And Steve, I don't know if you want to answer that one.
Yeah, so this is, it's currently an all bills paid. So the tenants are currently getting a lot of additional amenities for free. When they come in, the only thing they're paying for is their electric. They have free Wi-Fi, gas, all that good stuff. So so we were careful on other income. We wanted to make sure we were still adding value and it could be absorbed in the property. The rents, if you look at the comps in the area, if you adjust our rents for not all bills paid and make it for other properties in the area, we're actually below and we have room to run and get to our pro forma rents. So we're confident there. We will also look at possibly starting a rub back program in which we'll stop with the rent increases, so we can look at it from both ways. But we're super confident that we can hit our pro forma rents and still rub back a small amount to them, to the tenants, for some of the additional stuff that we're going to add to the property.
So Steve, I think we show a lot of other income items, but in our underwriting, we increased other income only by 20,000 in year 1 and year 2.
That's correct. So the first year we added about 30% of our total business plan other income. I believe we're taking 25% in year 2 and 10% in year 3, still below the 100%, and actually recognizing that. So again, conservative in the underwriting, but yes, that's true.
Okay. The next question is, why is the vacancy so high right now? So vacancy is so high because it's a beautiful asset. People want to live in nice upgraded assets with a lot of amenities. And this has been renovated since 2018. So it's in operations for 4 years now. And this is one of highly desirable location and beautifully upgraded properties. So I think that's what is causing the vacancy rate to be so high.
Did you say vacancy, Sarbi? Or occupancy?
High. So I meant it like they meant occupancy so high. So vacancy is not very high. Vacancy is, we are at 94% occupancy. Right. Just 6% vacancy, which is pretty standard. I think if we can keep it at 94% occupancy, like we'll be making much more than what we have underwritten. We have underwritten 15% vacancy, which is 85% occupancy, and we are at 96% right now. So.
I think the 94% vacancy, I think, is the number that I saw, translates into less than 5 units which are vacant. And again, I think most of these units are in transition in a sense. So the earlier tenant has moved out and the new tenant is yet to move in. So it's a snapshot at any point of time.
So the next question is, how much are we raising, and are there any different classes of shares? Let's see if that's something you want to answer.
Maybe I can take that one, Surabhi.
Yeah, go ahead, Jay.
Yeah, so we have only one class type here. So basically, there is no class A or class B like you guys have seen in the other opportunities. So this is only simply one class, and as Surabhi mentioned, that will be 80-20 split, and cash returns up to 2x multiple will be 80-20, and beyond 2x multiple it will be 70-30. So there is only one class type, and we are raising about $5.8 to $6 million. So it's not a big raise, say.
How about the depreciation for 2022? So as soon as we close this property, we will do the cost segregation analysis. We didn't mention too much about this, but 2022 is the last year when we can get 100% bonus depreciation. It will get started to phase out from next year onwards. We are expecting about 50 to 60% of the investment to give a depreciation on that. So let's say if someone invested 100K, we're expecting to give 50 to 60,000 as depreciation in year one, which will help them to bring down their taxes if they have other income passive sources.
Just a note on that, please get with your CPA and confirm that that's applicable to you. It's not applicable to everybody.
Okay. So the next question is, can you invest with a combination of IRA and personal money? Like for example, 25K from solo 401K and 50K personal money. So
Yes, you can.
Yeah,
I think that we can.
Go ahead.
Yeah, I think we can accept that. Some 25% from the IRA and 25% from personal money. We can accept.
The next question is really interesting. It says, why is the 12-month vacancy rate about 18%? Although this is a new property in an attractive area. So most of this economic vacancy is coming from loss to lease. And last 2 years, if you guys remember, have been hit with COVID. So the builder was trying to sell this property. They didn't want to lose the tenants, so they have not increased the rents up to the market. So most of this vacancy, economic vacancy, is because of loss to lease and the rents being below market. That's an opportunity for us. We are expecting to increase rents by $100, $150 per unit and increase other income. So one thing we didn't talk about is no one else provides free cable, Wi-Fi, internet. And it's costing us $52 per unit per month to provide this service. And if the tenants were to go to Spectrum and buy the same package, it would cost them $140. And right now they're getting it for free. So that's another opportunity we have not even talked about in our underwriting. No other property in any area provides free cable Wi-Fi. So if we just charge $25 a month going forward, it gives a value of $140 to the tenant. That's a huge opportunity for us. So the next question is, after 5 years, is there an option to stay invested in the deal? So I think the way it will work is our loan is a 5-year loan, right? So and again, some people may want their money to be returned, and others may want to hold this property. And promoters return the money to existing investors and sell the property to a new syndication, which they manage, and the existing investors can become part of the new syndication. So if this property is still attractive and we want to hold it, we can do that. That's an option. So that way, existing investors, whoever wants an exit, gets to exit, and the investors who want to stay can stay in the new syndication. That's an option for us. Do you already have a term sheet from Freddie Mac or still in process? We already have a term sheet. We have fixed the rate, so we have commitment. So we are not expecting any surprises on the interest rate. Who are the current tenants? How long they've been there? So I think we have the rent rolls. Steve, I don't know if you answer.
What was the question?
Who are the current tenants and how long they've been there?
We've had tenants as long as I think 5 years is the longest. We have some 5s and some 4s. The current tenants are blue collar workers. If you go through the parking lot, you'll see a lot of good looking cars, nothing beat up. It's in great look. We've talked about the location, but the tenant base is very strong, very good. There's virtually no delinquency here on this property, which is another key fact that there's some properties dealing with that around the country. We're not dealing with that. So that's all positives.
So Steve, the next question is on the split 70-30 and 80-20. I think, can you explain a little bit how that will work?
Yeah, so well, we don't have to go back to that slide. So until we reach or double the investment to investors, the split will remain 80-20 as underwritten. Now, if we exceed that and the returns increase through operation, forced appreciation, or market conditions, and we get over that 100% return to investors, the splits will then change or modify to 70-30, 70 to the investor pool and 30 to the general partnership.
And that 70-30 is above the 100%, right? That
just above the 100%. So once we double and exceed our underwriting and our projections, will the splits change? So not before that time.
Okay. Next question is, do you have data on schools? And we have not done data on schools because the kind of tenants we are looking for in this property are the young professionals, either single or a married couple. This property is not ideal for families or kids. So that's why we have not focused too much on schools.
Yeah, to add on to that, the majority of this property is studio and 1 bedroom. We have 5 2-bedroom units, and I think we're going to create another one with the townhouse unit. So our target market are, single mid-30s working professionals that want to be close to the nightlife, to good restaurants, and close to downtown, transit, airports, very mobile, active professionals.
So if there are 4 properties, does it increase the fixed cost in any way? So I would answer that maybe in a way it gives us more operational efficiency because we can share our expense across 4 properties. So we will have 1 office manager and 1 tech guy who can take care of all the 4 properties. So if it were 3 properties, then the same expense would be shared across 3 properties, but now we are sharing it across 4 properties. So that gives us a lot of operational expenses, operational efficiencies. So we can have we can cross collateralize the property. We can buy insurance, which is cross collateralized across 4 properties. So it gives us some negotiation power with all the vendors and contract services. So it actually helps us to have 4 properties.
Economies of scale is good for everything, not just the expenses, but it helps the returns overall, and operationally it's also very good.
So what would be the frequency of distribution? So we are looking to distribute the cash on a quarterly basis. So what was renovated in the last few years, and can you elaborate? So Akhilesh, I don't know if you want to answer that.
Yeah, so as I was saying earlier, out of the 4, 3 were built studs up in 2018. That means the builder actually took it to studs, kept the same trusses and the frames. Other than that, he put the whole new foundation, whole new plumbing right from the street, and then he built everything grounds up. All these interior features that you see there, all have been built 2018, 2019. He actually has added a metal roof on one of those buildings in the past few years. Some of the fixtures that he has added, but other than that, it's in a great shape, knock on the wood. And some of the additions that we're looking to do is mostly on the exteriors and not much on the interiors, other than washer dryers and other amenities in a sense.
Okay. So the next question is, annual return is 18 to 20% and cash return is 5 to 6%. How this has been calculated for investor? So these are the returns which the investors will make. So these are the returns after the sponsor split. So I'm not sure if that was the question or what is the intention of the question. If you can type some more in.
Surabhi, let me answer that question. Generally, when we say 18 to 20%, that's the overall return. but on quarterly we will distribute 5 to 6% cash on cash. Plus when we sell, we return the additional. So that's combined together 18 to 20% return annually.
Yeah, this is what the investors will make. This is after the sponsors.
Yeah, correct.
Okay. Who will do the property management and what is the cost? So Steve, if you want to answer that.
Yeah, Mind Management is our property manager. They're a professional firm located right in the heart of Dallas and Fort Worth. They do have a few properties local, a few blocks away from San Jacinto. They are operating this property at 3%. So they'll take 3% of the gross receipts on a monthly basis, which for properties under 100 units is very good. A lot of property managers are looking for 4.5%. Because their costs are increasing with inflation and so on and so forth. Labor costs are increasing. We use Mayan on other properties of ours, so we have a great relationship with them. It'll be the same regional and same ownership, obviously. So we're excited to get to work with them on this asset as well.
Okay. Was plumbing inspected? And Akhilesh, I think you can talk about the inspection and structural engineering.
So the question is, what all things we have inspected?
Yeah, question specifically is, was plumbing inspected? But you can talk about all the inspections, right?
Okay. Yeah, actually, we did a step further for whatever reason. We actually did a structural engineer inspection from one of the most trusted firms or reputed firms in Dallas. And the report came out really good. There are some minor things that they have suggested to keep the property in a good shape 10-15 years down the road. I mean, we are not obligated to do it, but we really want to do it so that when we hand it over to the next buyer, it's in a great shape. Which is things like French drains and putting some moisture barriers, etc., etc. So I think we'll have a plan for both, and we'll do that in first few months.
And to answer the question on plumbing, the plumbing lines were scoped all the way to the street. So we put a camera in there and ran it through. And since everything was replaced in 2018, there's no buildup or backup there. So we're in good shape on plumbing.
And just to add to that, and also we had a roofer, we had electrician, plumber, foundation guy. So we have different experts to look at the property.
You can say that we have a lot of engineers in this sponsorship team and construction expertise. So I think you might be good on that.
Okay. So the last question is, does the 3% property management fee include
Well, include what?
payroll?
Yes. Oh, I'm sorry. No, it doesn't. Payroll is separate. So 3% is just their overhead. And then we have all of the operational costs are included in our expenses. So we are covering, we have labor costs, all their burden and overhead. Office supplies is all included in our expenses.
Yeah, so just to answer that, we have taken about 90,000 in payroll as a separate expense on top of 3% property management fee. So these are all the questions so far. Please feel free to type if there are any more questions.
While people are still wrapping up, I would just invite them to really take a look at the video and pay attention to the gentrification of the area. You can really see from the quick video that is that you guys received, the quality of the buildings that is coming up in that area. It's really an up and coming area. For me, it's really very exciting.
So a new question came up, who is the payroll for? So payroll is for the employees of the property management company. So if we have an on-site office manager, if we have a maintenance guy, so we are expecting at least one full-time office manager, and we are for now looking to outsource the maintenance because we don't have very heavy lift. But the payroll is to pay their salaries, which gets charged back to us. So Atul, you asked the question above, so I'm not sure what was. Okay, so I see some questions now. How you modeled inflation for payroll and repairs and maintenance. So if you, Taisha, can you go back to the underwriting slide? Yeah. So here, if you see, if you see in the top, we are saying there is a line row 3, which talks about annual expense increase. So we are looking at 7% annual expense increases in year 2 and 3, and then it goes back to normal reversion, which is about 3%. So this includes inflation for payroll, repairs, maintenance, all those kind of things. So it says, what is the vacant area behind the property? So I think a lot of people have asked this question. There is a small vacant lot. We don't know what this will be used for, whether it's commercial or retail. So we really don't know what's going to come on that small lot.
Surabhi, I just wanted to add it for this property. I used to work in this particular area in Dallas downtown, which is Baylor Medical Center, one of the head office there, and which is less than half a mile from our property. And that area alone, more than 1,000 jobs there, Baylor Medical Center has created. That's a very attractive. People can walk from our apartment to the Baylor hospitals.
So the next question is, what is the square foot size of the neighborhood, as price per door is 30% lower? So we have toured a lot of properties in this neighborhood. We looked at some properties just across the street also. So typically we are seeing the average square feet is around like 550 to 600, and this property is about 500 square feet. And the properties we toured with 550 to 600 square feet average size, they're asking for 183,000 per door. Another property is asking for 200,000 per door. Um, I'm not sure if that translates to a higher price, because the square footage difference is not much higher, and even the rents are not much higher. So even though some properties have a little bit more square feet, we're not as the square feet increases, the rents per square feet actually go down. And I don't know, Akhilesh, if you want to add some more over here.
So that's true. If you compare the properties in the neighborhood, they may be marginally higher in square feet, but the way real estate works, even if your property is marginally lower in square feet but has a much higher quality fixtures, the way it's constructed, both interiors, exterior, it actually commands a higher dollar per square feet rate, not just in the purchase price but in the rents as well. And that's what we are seeing here as well.
Okay. The next question is there a chance to turn the property in 3 years or sooner? And what is the sponsor goal for exit strategy? So Steve, you want to answer that?
Sure. So we underwrite to a 5-year hold. Obviously, every year we'll look at market conditions. We'll look at our expenses. There's a lot of things we look at quarterly and yearly. Every year we will look at what the market is telling us. We'll look at cap rates in the area, how the property is operating, and if it makes sense to sell based on the annual return, and we're close or near the promise to investors, we'll sell. If not, if we believe that the forecast is still advantageous for us to hold, we'll continue to hold. If we get to a point where it's give or take, it's good to sell and it also looks good to hold, we can send out something to investors and get everyone's input to take a pulse on what everyone is seeing and how they feel about the property. So on top of that, you guys we'll send out quarterly emails with all of our financial reporting to everybody on a monthly basis. We'll keep you informed with all of our CapEx, how the property's performing, if we have any issues, any highlights, We like to do events on site with our property manager to kind of build rapport on the property and retain tenants. So we'll keep you informed on everything that's going on the property, especially sale or any kind of capital changes that we forecast making before we make them. And what was the follow-up question, Serbi?
So the next question, what is the sponsor's goal for exit strategy?
So we have a few. Serbi went through them. Some of them are based on interest rate and what the market is doing. We can certainly cash out refi. We have a 5-year loan. So before 5 years, we're either going to have to sell or refinance. So that decision will obviously have to be made in the next 3 to 4 years. So we can position the property before that 5th year to exit the property. So we can either refinance, put it back on the market and sell it. But those are the two big exit opportunities that we have here.
So the next question is, what's the personal investment from the GPs? So I think the minimum investment needed from the GPs is at least 10%, and that's the lender requirement, and that's the minimum which we will do. We may do more based on how the race goes, and this is a very attractive opportunity. So some of the GPs have indicated that they might bring their own personal money and invest way more than what's needed, but at least at a minimum we'll invest 10%. So does this property attract any white collar professionals? Students are only blue collar? And what are the blue collar jobs or industries? So Steve, is that something you want to answer?
Yeah, that's lack of information on my part. Blue collar, white collar, I got it mixed up. But anyway, there's a lot of executive type jobs here. Looking through the rent rolls and professions, doing our audit of who's living there. You have a lot of people in the medical profession, financial profession, and also some startup as well. So there's some business owners also on the property. We do have working class people in unions as well. So we have a very diverse mix of individual that meets our tenant base.
Okay. How are the distributions provided to investors, and is it quarterly? So when you sign up on the portal to subscribe to this offering, you will be required to provide your bank information for ACH. So every quarter we'll be sending the distribution via ACH to the bank that you provide when you sign up for the subscription, and it will be quarterly. So the next question is, can you refinance in 3 years and return LP's money, including 2x returns, and still keep the property with the GPs? So once we get into the syndication, we are in it together. So it's not like we return investors' money and then we can hold it, right? So whatever money we make, it has to be split 80-20. So we can always refinance and return investors' money, but they still own the property along with us. So they still have 80% ownership in the property. So what we can do is, as I mentioned earlier, like if some investors want to exit and other want to stay, we can sell this property from one syndication to the next syndication, and whoever wants to exit gets their money back and the returns, 2x return, at least that's what we have promised. And then the new set of investors can own this property and take it forward. So who actually on GP will be on top of this deal on the detail from management and financial point of view? So I think we have Steve, myself, and Hanumesh as the lead asset managers on this property. So we will be the ones, once we close this property, we'll be working with the property management company on a weekly basis and reviewing the financials and sending updates to investors on a monthly basis. What is the criteria for investor selection? So this is a 506B offering. So the main criteria is, first of all, that you need to have a pre-existing relationship with one of the sponsors on the team. The second criteria is that since this is a 506B offering, we can take unlimited number of accredited investors. And accredited investor definition is like you should either have over $1 million of net worth, not including your principal residence, or you should have made $200,000 in income as a single earner, or $300,000 per year as a married couple in last 2 years. So if you meet that criteria, we can take you as an accredited investor. If you're not accredited, you may be a sophisticated investor, which means that you don't meet the net worth qualification, but you have sufficient knowledge and experience to invest in these kind of deals. And we have a limit of 35 sophisticated investors that can be accepted into a deal. So these are the two major qualification criteria that we will look before we accept any investor. So next question is, if the target 2x return are obtained in 3 years, will you exit or hold till the 5 years are over? So I think that will be a good problem to have. So if we hit 2x, I think as Steve mentioned, we will reach out to investors and take feedback. If majority of investors want to exit, we will exit. If people want to hold, we may hold, or if, as I said, we can let some people exit and transfer it to a new syndication and let whoever wants to come into new syndication. So there are a lot of strategies we can take if we hit our returns sooner. How much investment has been secured, if any? So I think we have a lot of soft commitments. I personally have probably more than $1 million in soft commitment, as do other GPs. So as soon as we open the portal tomorrow, we will start getting these subscriptions. But I think we are pretty far along. We have a lot of commitments from people. Do you require certificate or self-attestation for accredited sophisticated? So since this is a 506B, we don't need any proof. When you sign the documents on the portal, you will just need to complete the investor suitability questionnaire, and it will ask you whether you consider yourself as accredited, yes, no. And you will just select why you are accredited. You can select the $1 million net worth, or 200,000 or 300,000 income. And that's all we need from you. We don't need any certificate from the CPA or anything. So I think these are the questions so far, and we are almost at time. So unless there are any last minute questions, we'll stop here. So anything from GPs, anyone wants to add anything last minute?
No, obviously we appreciate everybody taking the time tonight. If there are any questions that you didn't put in the chat box or wanted to follow up, get with the individual on the team that invited you. We'll send out instructions on how to complete the subscription agreements. And of course, any questions, please get with them. We do expect to move fast. So get with them today, tomorrow, and get the next steps lined out. If you are planning to invest with IRA funds and you don't have your IRA or self-directed IRA set up yet, get with your sponsor, and they will hold a spot for you as long as we can. And let's get that stuff moving. It usually takes 2 to 3 weeks just to get that account funded. So please get with your sponsors and let them know if you're interested in how you plan on investing, so we can make sure there's room for you.
I would like to just expand on what Steve said, that there may be some of you who are new to this multifamily investment concept. So we will be sending the recording of this webinar along with the slide deck to all of you. So go through it, please. And if you have any questions, get with your sponsor.
Okay, thank you so much, everyone, and hope we'll see you as investors in this deal and many more deals in future. Have a good evening. Take care. Bye.